Welcome back to Everything Money. In this video, you will learn about the financials of Intel and the stock. We will go through a fundamental analysis, show you why we are investing in Intel, and we will also give you a price you should be paying for this undervalued company moving forward. If you're looking to trade Intel at a quicker pace, you can join Mo in the Bid and Ask. He will show you all the trends and all the charts later in the video. But first, why should you be watching us? I bring your questions about this chipmaker company to a couple guys that manage about $100 million in real estate, multiple businesses, and stocks. This is the real deal, and they will answer your questions you need to know about Intel, investing in Intel moving forward. Paul, I know you love this company. Tell me about it.
All right, guys. So thanks very much. Please follow us on Instagram. We have a new Everything Money investing account, and then follow us personally so our moms don't disown us. So guys, Intel is a big one for us. We've talked about Intel a lot in the past.
Yeah.
I'm a buyer of Intel. I like it. I think it's grossly undervalued. Okay. The chip industry, everybody says, oh, AMD is taking over. I've heard this for the last 20 years. And guess what? The chip industry is a very big pie. The pie is growing as the world develops more and more. And I do believe AMD will take over more share of the market than Intel. Intel might lose share. But remember, guys, if the pie is growing from this to this, even losing market share, you can still make a lot of money.
Ah, okay.
Yes. Now, what we've done also, now this is our Everything Money software. So let's go to our 8 Pillars tools section. Aren't we 8 Pillar tools? Mm-hmm. Hit Intel. So let's first start with our 8 Pillar analysis first and foremost, and then we're gonna get into some more of the information that I'm seeing out there, which I understand, and my comments of them going forward. So guys.
Perfect.
The company is a $206 billion company. Now, this is one of our best examples. Look at this chart. 20 years ago, you couldn't find anybody who hated Intel here. 20 years later, their revenue and profit is 2 and 3 times larger, and the stock is still selling for lower amounts of money. This happens at every market bubble. So just keep that in mind going forward. Pillar number 1, we want the 5-year PE to be less than 22.5. 11.3, half the amount.
Very nice.
Check mark there. Yeah! Look at this healthy margin, 27%. Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. It is 12%. This means that they do a good job of investing the capital that is in the business through debt and equity. Great job there. Now, dividend here. This is going to be part of our conversation because a lot of people are concerned about this dividend. Guys, their dividend yield is 2.7%, pays out $5.6 billion. If you are smart and you ask the question, wait, if they're increasing their capital expenditures and their free cash flow is going to drop, does that concern the dividend? Absolutely, it should be a concern. You should always look, whenever you see a dividend, this is why we added to our software here. Our exclusive software has it up right above it. So you can compare the dividends paid to how much free cash flow they generate. And they have ample money right now based in the past. Now going forward, we will discuss that. So far, 2 check marks.
Pillar number 3 is revenue growth over the past 5 years, Paul.
Absolutely. So we go to our income statement on our software. It's right here at the top. We scroll down just a little bit. 62 billion, 78.5. Check mark there. Barely any growth over the last year. Understood. Pillar number 4, net income growth.
Yeah, profit. Paul, for a normal person like me who only ever bought stock prices based on tickers, I just love this is the basis of the show, is looking at financials. It's just incredible,
Absolutely.
really.
And it makes you feel a lot easier. The more and more you do this, the more and more it becomes ingrained in you that you're basically looking at your personal life. No, every company is like you managing your own personal expenses. And your net worth will go up based on your income and your expenses and your assets. That's it. No different here. So, pillar number 4 was profit growth. 13.85 to $21.1 billion.
Check, please.
Massive check mark. Pillar number 5, Uncle Seth. This
Shares
is the big one.
Yeah.
Now, share dilution is a big deal, guys. Nobody really talks about this, but when you have a company that's issuing a lot of shares, they're diluting you as an owner. The example I always give is, let's say you own 10 shares of a company that has 100 shares outstanding. You own 10% of the business. If they increase the number of shares by 20 to 120, you still own 10 shares, but now out of 120 shares, you own 8.3% of the business now. You have been diluted. This gives you a smaller piece of the revenue and profit. So in a slow-growing business, especially if they're issuing more shares, that might not be enough to cover the revenue and profit growth. You might actually be losing earnings per share.
Paul, how many normal people are investing in companies that they probably don't even know this is ever happening underneath the hood of these companies, right?
And we've been very fortunate to go to 100,000 subscribers, but we are not going to be the investing channel for the masses. We do think we're the best investing channel, but this is for the person who goes, wait a second, that makes sense. What I just said about Every company is like your personal life. Look at income, expenses, debt, all these things. That's all it is. You have to look at them the same way. So on Intel, 5 years ago, 4.69 billion shares outstanding, now 4.06. They are decreasing the shares outstanding. And I love that with such a cheap stock price because they're investing their cash, basically buying a cheap stock. It doesn't matter if it's theirs or somebody else's. They're buying their own stock back cheap. And they're saving that dividend. Because every single time they buy a share back, that's 2.7% less they have to pay out in dividends.
You've never said that before. I never thought about it.
I've said it before a few times. But in this situation, it matters because it's a healthy dividend yield.
Wow,
it's double the market.
Okay, pillar number 6, Paul.
Pillar number 6 is our debt. Seth, please explain the debt. Because this is something that a lot of people also don't look at.
You're absolutely right. So if there is a recession, we want to find companies who can outlast this. If they have a ton of debt, they have a better chance, as Warren Buffett say, they have a better chance of going down. And so we want to make sure we're investing in companies that don't have a ton of debt. So how do they cover this debt, Paul?
Right. So Warren Buffett always says, whenever I see a smart person go broke, it's always because of debt, right? So Mo, you've been paying attention. How do we calculate our debt number here?
Oh, I have no idea.
Guys, it just goes to show you that even my homies on the show. So guys, we go back to our main page.
He's a trading specialist.
We picked the 5-year. By the way, that's exactly the point. Mo is the trading expert. If he asked me, Paul, talk about an engulfing candlestick, I'd be like, what? I don't know.
I'm still learning from Paul, just like you guys are.
Yeah, same with me in the charts. So we go to our 5-year average free cash flow, $15.7 billion. We multiply by 5. That's $78 billion. So what we want to do here is we want to go see if their long-term liabilities are under $78 billion. So we scroll up to the top, go to the balance sheet, scroll all the way to the bottom. Long-term liabilities, 48.3. A chickadee check.
We Gucci.
We Gucci. Does I just sound very old and very white?
I love when you do that. I just love it.
The chickadee check. I got that from Darnell.
Yeah, keep
So
going.
guys, pillars 7 and 8 are all based on cash flow. Cash flow is the most important part of a business for me. Why is that, Seth?
Yeah, I didn't know this until you started stressing it, and now I love it. Income can be manipulated, as you say, but it's harder for free cash flow, and free cash flow is really the fuel, the lifeblood of the company when you say that. I love that.
Correct. So you use free cash flow to do one of 5 things: pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back in yourself. Okay? Those are the 5 things. You don't have free cash, it's going to be hard. So we go to the cash flow part of our website. We scroll a little bit to the bottom. And once Xavier puts the screen, there you go. So guys, free cash flow is cash from operations less our capital expenditures. Your Uncle Paul here, your non-creepy Uncle Paul, added this line
Allegedly.
to the free cash flow statement, non-creepy version. And that way the math is easy for you. 11.78 billion to 17.33 billion. That's a check mark. And our final pillar, we take that 5-year average free cash flow of 15.7 and we multiply it by 20. This is a starting point for a valuation. Does this mean this is the hard set rule? No. A fast-growing company deserves a higher valuation than a low-growing company, but we have to start somewhere. So we start at 20. So 15.7 times 20 is $314 billion. The market cap is 205. That is a check mark all over.
Yikes! That's wow.
That's awesome. So just to make the math easy for you, to show you guys, here at the top is the 8 pillars tab, and it's an all 8 check mark. So if you guys sat there and said, boy, it's a lot of math, well, guess what? Our software does it all for you very easily. Look at this. Everything is 8 checks. Now, does that mean you go out and buy this thing? Not necessarily. We're going to use the stock analyzer tool next. You got to do more due diligence with the company before you buy them. Understand the business, because they are going to lose. Their free cash flow is going to drop very strong soon, but for good reasons. They're going to invest back in the business. Yep. But let's go to the stock analyzer tool. This has been one of our most successful and most popular items of our software. We use this because every investment is the present value of all future cash flow, right? So we use the stock analyzer tool to put our assumptions in because we don't know the future. The future is unknown. All we can do is make conservative assumptions, and hopefully it spits out at the end a price that we sit there and go, oh, the price is selling currently for less than that. So first things first, years of analysis. You can pick 1 to 20. I always pick 10. Now I've always picked 10 when it comes to companies that are going to be around. Do we doubt Intel will be around in the next 10 years?
No, I think it's safe to say they'll be around.
Yes, I think it's more likely to be around than we are to be around. Number of assumptions. A lot of people love the 3 assumptions. So we stick with those. So guys, here's the deal. This is not a fast-growing company. Seth, look at these numbers here. In the last 1, 5, and 10 years, the revenue growth has been, and a lot of this is from acquisitions too. Mm-hmm. So I want to put numbers in here not based on acquisitions, based on that they just grew themselves. That's it. Just grow themselves. Don't worry about acquisitions. Just growing themselves. What kind of numbers do we want to put in for Intel?
I'm almost probably 1, 2, 3. I'm almost inclined to say 0, 1, 2.
Uncle Seth?
Yeah, I like what Mo said.
Which one?
0, 1, 2.
I was actually going to say 0, 1, 2.
Yeah.
Or 0, 2, 4. And the reason I was going to say 4 on the high end is because inflation's kicking up and demand for chips is going to increase as the world develops more. So do you guys mind if we do 0, 2, 4?
No, that's fine. Also, they do have a very, we haven't talked about it yet, but they have a very good path going forward. They've said exactly what they want to do through 2024. So, possible.
Now remember, this is assuming no acquisitions. So 0, 2, 4.
That's why I said 0.
Now, profit margin. Their profit margin increased over the last 10 years. But I think that with their fight with AMD, it might put some pressure on margins, but they're also growing some other aspects of their business that are higher margin, but they're small parts of the business right now. This is something you have to know. Go do your research on Intel. They have fast-growing portions of the business that are growing at multiple double digits a year, but they're very small portion. They only account for 2 or 3% of the business right now. So give me a profit margin based on the last, give me 3 profit margin levels.
18, 20, 22.
Why so?
I agree with Seth. Why so low? I don't think margin is going to drop by 5 basis points.
Well,
5
I
points,
mean, it is like, look, I look at this saying, if they come out and they're 22, 23, they're going to be the dominant player in the market. I don't need them to be the dominant player in the market. If their profit margin drops, that's fine with me. And you know what I'm saying? Like everybody's looking at it saying, Intel needs to be number 1. Why? I don't care if they're not number 1. If profit margin drops, that's fine.
Yeah, but 5% drop in profit margin is a big drop.
But
that's a 20% drop.
Between chip shortages and a lot of competition coming in,
okay,
it's possible.
So what were your numbers?
18, 20, 22. Seth, what did you think?
Yeah, I'm confused why your high is lower than the lowest of low here. Yeah, 10 years.
Because he assumes more competition, things like that.
Yeah.
How does that affect profit margin?
Well, more competition at their lower prices in order to make sure they stay up on things, increase their R&D, things like that.
And walk me through this a bit, because I sort of play you, the viewer. In the end, I just need the stock price to go up. Am I right or wrong?
Well, the stock prices goes up or down based on the fundamentals of the business.
Thank you.
And these are the fundamentals of the business.
Okay, keep going.
So for free cash flow margin, I do the exact same thing. Exact same numbers. Why? Because over long periods of time, free cash flow, MP, for the most part, unless certain industries are different based on how they look at depreciation and things like that, but for the most part, I'm going to keep it exactly the same. Now, PE, guys. The current PE in the company is 9.8, and the current price of free cash flow is 12. Give me some multiples along the way.
If the PE and price to free cash flow is that low, did we make a mistake in adding a 20x multiple to pillar number 7?
That's the point of doing... That's the point of looking at this analysis. You don't just take it as, that was pillar number 8. That's why we do this. But I actually think these PEs and price-free cash flows are too low.
I think it's, I was going to say 11, 13, 15, because look, we're buying it at a value, so it is cheap right now.
I love it. And I think that the valuations will increase over time, correct?
Okay.
And for desired annual return, we always do 12.5%. Can you please explain to everybody why, Seth?
Yeah, I mean, if you want to put your money into standard ETF, VO, Vanguard, or SPY, you're going to get a little under 10%. And so if you want to put your money in just one company and have the risk of having this company go down and lose your money, you want a higher reward, which would be 12.5. So we want to get that bigger reward.
So we hit the analyze button, very simply, guys, and it's going to give us some values. Okay, so I think we went conservative here. And the high number is $57. The middle is $42. Guys, I think we're too conservative these numbers up top. That's why I'm a buyer of Intel anywhere sub 50.
What change would you make in the stock analyzer?
I think the revenue number is where I'd probably change it.
Okay.
And the profit margin especially.
Margin, yeah.
So like for revenue growth, I would be fine with 1, 3, and 5, and profit margin 20, 22, 24. Because I do think it's possible that they still increase their profit margin.
Mm-hmm. What do you got?
It's basically selling for what it's supposed to be at right now for the middle assumption, which gets you a 12.5% return. But I think there's a lot of upside in this company. That's the big thing. It's not like a Tesla video we just did where the entire gain is based on it has to hit all the upsides that are all egregious, right? These are reasonable assumptions going forward. 5% revenue growth. If we have inflation of 4 or 5% for the next 5, 6, 7 years, that alone will
There's
drive.
your number.
Yeah, I look at that going, okay, I'm okay with this.
It's interesting you brought up Tesla. Ball. At the beginning of the stock analyst, you said, do we think this will be around for 10 years? And I thought, probably, because in comparison to a company like Tesla, this is the exact opposite. We think this is an undervalued company that we're currently buying, not overvalued. But Paul, I just happened on a whim, typed in the top companies from just 10 years ago, now 11, 2010. Look at my screen, Paul. Walmart, Exxon, Chevron, GE, Bank of America, ConocoPhillips, AT&T, Ford, JP Morgan. Like some of these are like way down the list now. I mean, just to think that these were the top companies in 2010, how much has changed and how the Tesla folks think that it's just going to just
keep going.
Keep going
it
and
might
going
happen.
and going. It
Guys,
might, but
it very well could happen. Remember, investing is about odds. You're at the blackjack table, and every single time a new card comes out, the odds change. The new card for us is valuations. Every time the valuation changes, your decision to buy or sell changes. That should be it. Because if Tesla tomorrow dropped by 99% in stock price, theoretically, does that mean that the stock has gone nowhere? Does that mean the company's going nowhere and it's going to zero? No. This happens all the time. Look at Intel. Intel stock has gone nowhere in the last 20 years, and the company has doubled and tripled in size. Please tell me you understand that. Please go like this and say, send me vibes.
Lord baby Jesus.
Telepathic vibes. Just say, Paul, I understand. Tesla was selling for $80 a share 20 years ago. The business is 2 or 3 times larger. They have 2 or 3 times more profit. And now the company is selling for less. It's just because why? It was so overvalued back in the day.
Mm-hmm.
Stocks are a voting machine in the short run and a weighing machine in the long run. And this software all does this for you.
Yeah, so if this resonates with you, Paul will tell you right now how to get what's behind him.
So we created the software because our original subscribers wanted to be able to do their own research and analysis without waiting for us to make more videos. So we created the software just for them. What's included is everything you saw here, including our amazing stock analyzer tool. You get 30 years of financial data, access to Seth Moe and I. You get exclusive daily content, 2 or 3 videos per day sent to you only through our software and our mobile app. This software back here is on the App Store and Android, so you can use it on the go. Everything there is included. All the extras, retirement calculator, real estate calculator, everything here is all going to be included in your subscription. But most importantly, if you feel alone out there, which a lot of our subscribers do, they joined our community with over 6,000 people, and now they can talk to everyone around the world 24 hours a day about their own investment ideas to bounce things off each other, talk about things. You're no longer alone in your own island. You can have these conversations with everybody. This is all available for only 90 cents per day. This is a no-brainer, 90 cents per day. If you're just able to either increase your returns by 1% or decrease your losses by 1%, this could lead to hundreds of thousands, if not millions of dollars a year. And you can also fire your financial planner, saving hundreds of thousands of dollars in your lifetime. So sign up, everythingmoney.com or Patreon. Either one gets you access within minutes. The benefit of everythingmoney.com is we do not charge sales tax yet because of our size. So sign up, 90 cents a day, less than a cup of coffee, no brainer. Make the best decision if you are serious about your financial future.
If you're looking to trade Intel at a quicker pace, we will head over to Mo, the glorious leader of that Bidnass Nation, the top tier in our community, the trading community. Go ahead, Mo. Tell us what's going on.
So everyone is loving Intel right now because of that gap that happened
the gap's
on
gonna
earnings.
fill.
Yeah. So right now it's kind of turning into this dog stock where it can't break out. It filled. Let's draw this a little bit better. It filled this gap right here. So now it has to fill this top side. What it's going to need, it's going to need a lot of volume and a lot of momentum pushing it that way. Why don't we go over to the daily chart and just see what exactly is happening? Because I think this is more conducive to be a swing trade for you guys than a long-term play at this point in time. So right now, you are just pummeled right below, all 4 major moving averages. You see it popped up to the 25 and couldn't do it. Volume is very low, and we are in a downtrend. So if you want to, you can wait for an engulfing candlestick coming right down and try to short this thing back to this $48 level or something. But what I would tell you more to do, go over to a day trading chart. Look at what you have a lot of movement on Intel, both up and down. And if you just look at it this morning, this is a good example.
Holy cow.
This is why we wait until, I always say wait until 10 a.m. to start doing your day trades, because you can often get a big spike at 9:30, and all of a sudden it comes straight back down, and that's exactly what happened. And that's why you also have to follow your stochastic. You notice that when you open the morning, this thing started up here and it just dropped straight down into an area where you're not in the sweet spot. So what do you want to do here? Wait until this thing gets below 20%, and then go and add on these engulfing candlesticks short. So there's a method to the madness, guys. If you want to learn this, come and join me in the Bid and Ask Nation. You can learn the day trade, swing trade, or long-term trade. You get access to the Trading 101 series, which is everything that you need to get started, the Employed Trader series, and the Discord community with 900 people that think all the same way. And if you want to learn to trade, come and join me over there.
Final take on Intel, Paul.
So one thing I will say about Intel, their free cash flow is going to drop precipitously in the future. They're reinvesting back in their business and growing their business. Do I think their dividend is at risk? Potentially. But they have ample cash on hand to pay that dividend and keep people interested. And I think that's probably more likely because at the end of the day, these boards know and these CEOs know that people like their dividend. So I think it's going to be hard for them to cut their dividend, especially with all the other questions about the business. So just be ready for a drop in free cash flow. It's going to happen, but it's hopefully an investment in the future to long-term growth.
That's our take on Intel. We will keep you updated as the year progresses. And we thank you for watching. Follow, thumbs up, join the community. We'll see you next video. Appreciate it.